So let's get started with beta. We noted earlier that we can measure a firm's systematic risk with beta. And you have probably heard of beta or seen beta perhaps when looking up a stock quote. What is this? What is beta? Well, more formally, beta, or the beta coefficient, is the amount of systematic risk that a risky asset has relative to the average asset. So in the case of stocks, it's the amount of risk that one particular stock has relative to every other stock in the stock market. So by definition, an average asset has to have a beta of 1. So what does this tell us? What does beta tell us? A beta of 1 implies that the asset has the same systematic risk as the overall market. A beta of less than 1 implies the asset has less systematic risk than the overall market. And you guessed it, a beta of greater than 1 implies the asset has more systematic risk than the overall market. A stock with a beta of 0.5, for example, would have half as much systematic risk as the average stock in the stock market. A beta of 2.0 would have twice as much systematic risk as the average stock in the market. Now let's move on to an example. In this chart, we've estimated betas for a few well-known companies to give you an idea of how this works. What you see is, currently, Coca-Cola has a beta of 0.35, Walmart a beta of 0.5, Microsoft a beta of 0.89, Apple has a beta of 1.24, NVIDIA a beta of 1.72. As reference of comparison, you'll notice that the S&P 500, the broader market, has a beta of 1.0 precisely, because we are measuring against that broader market, the S&P 500. NASDAQ, as comparison, has a beta of 1.2. That's not surprising. Think about companies that comprise the NASDAQ. NASDAQ tends to have younger companies, tends to have smaller companies. NASDAQ tends to have more tech-type companies. These companies are more risky. We see that the NASDAQ market has a significantly higher level of risk than the S&P 500. Walmart, we see, has half the amount of risk of the average stock in the stock market, or the S&P 500. NVIDIA has a beta of 1.72, or 1.72 times the risk of the S&P 500. Remember that as an investor, we only get paid for taking on systematic risk. Thus, our expected return, and our risk premium, by the way, only depends on systematic risk, not total risk. Stocks with larger betas, more systematic risk, have higher expected returns. So using this table then, we can infer that if we invest in Walmart, beta of 0.5, we should expect to earn a return that is about half of that of the S&P 500, beta of 1.0, and significantly less than if we invested in NVIDIA, which has a beta of 1.72. You already knew that Walmart was a lot less risky than NVIDIA. What we've been able to do with beta is quantify it to see how much more risky NVIDIA is, and therefore how much more expected return you should get. In the previous video, we illustrated how beta is a measure of systematic risk. And as such, it should be the focus when determining the risk and expected return of a potential investment. Let's emphasize this with a simple example. Consider two potential investments. We're just going to call this stock A and stock B. And what we have here are two different measures of risk. We have standard deviation. For stock A, it's 25%. For stock B, the standard deviation is 35%. And then we have our beta. The beta for stock A is 1.3. The beta for stock B is 0.9. So examining these two stocks, let me ask you, which of these two stocks has the most total risk? And your answer would be, clearly stock B has more total risk. Recall that we said standard deviation is a measure of the total risk using the returns. And so stock B has a higher standard deviation. It has more total risk. Which stock has the most systematic risk? If you'll notice, the answer flips. Stock A. Stock A has a beta of 1.3 compared to stock B, a beta of 0.9. Stock A has the most systematic risk. Which security should have the higher expected return? Well, stock A has the highest beta. Therefore, stock A will have the higher expected return and the higher risk premium, even though it has less total risk. Remember, as an investor, we only get paid to take on systematic risk, or beta.